Hi everyone, welcome to the next installment of Charts and Perspective, where we use charts to dive into the world of economics. I'm Jennifer Nash, an economic and market research analyst for Verify. Today we're going to look at the monthly moving averages for the IB portfolio and the S&P 500. In a previous video, I discussed the IB portfolio and what it is, but I'm happy to provide a refresher. It's an equally weighted portfolio constructed with 5 ETFs that feature a mix of different asset classes, including domestic and international stocks, bonds, real estate, and commodities. For each fund, I compute a moving average of the closing prices over the last 10 months. If the fund closes below the level of its moving average, the signal is to sell and hold cash. If it closes above, the signal is to invest. As you can see, this approach requires monthly attention, which is why I updated on the Advisor Perspectives website each month after the close on the last business day. Now that January has ended, we can look at the updated signals for each of the 5 ETFs that make up the IB portfolio. At the end of January, all 5 ETFs closed above their 10-month moving average, so we would invest in all 5. We can also see the percent of how far each fund is from their moving average. The positions that are less than 2% are highlighted in yellow to emphasize that they're close to reversing positions, like the VEU and IEF funds. Now, for a slightly different view, we've replicated this process but used monthly closes for the past 12 months instead of 10. By lengthening our time frame, the moving averages become slightly less volatile. But again, we can see that at the end of January, all 5 ETFs closed above their 12-month moving averages. Now let's look at the broader market. The S&P started off the new year on a high note, gaining 2.7% in January. But let's examine the market through the lens of moving averages. To reiterate, we're looking at the index's close on the last day of each month, not the index's daily closes or monthly average of closes, and calculating a moving average based on the prior 10 months. And if the current close is above the moving average, then we hold. But if it closes below, then we move to cash. At the end of January, the index closed 7.2% above its 10-month moving average. So for a 15th consecutive month, the position is to invest. A disadvantage to this method is that it never gets you out of the top or back in at the bottom. Nevertheless, from this chart, we can see that this strategy would have ensured participation in most of the upside price movement. To further demonstrate the strategy's effectiveness, here's the same chart, but this time using a 12-month moving average. Again, at the end of January, the position is to invest, since the index closed 8.7% above its 12-month moving average. As we can see, the 12-month moving average is just as, if not more effective, than the 10-month in reducing losses. Our last variation to the strategy uses the 10-month exponential moving average, which is a slight variant to the simple approach used in the previous 2 charts. In this version, we mathematically increase the weighting of newer data in the 10-month sequence. Unsurprisingly, at the end of January, the index closed 7% above its 10-month exponential moving average, so again, the position is to invest. Since 1995, this variation has produced fewer whipsaws than the equivalent simple moving average. However, it was 1 month slower to signal a sell after the 2 market tops in 2000 and 2007. So to summarize, all 3 approaches flashed a hold and invest position at the end of January. In fact, the last time any of the methods were in a cash position was over a year ago, back in October 2023. And now timing works because of a basic human trait. People imitate successful behavior. They see others making money in the market, so they buy in. Eventually, the trend reverses. And when it does, successful investors sell early. The imitation of success gradually turns the previous buying momentum into selling momentum. And then eventually the trend reverses again, and again, and again, and so on. And to close out, I do want to point out that our S&P illustrations serve as examples, not trading signals. I use this index because of its extensive historical data, but moving average strategies should be applied to individual investments, not a broad index. Even funds tracking the S&P 500, like SPY, may generate different signals due to dividend reinvestment, which my illustrations do not include. That's all for our January moving averages update. Thank you for tuning in. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Chart section.